Earnings season starts tomorrow. And I know that everybody is really caught up on JP Morgan, Citigroup, and a bunch of other companies that otherwise, they're going to be in the headlines. They're absolutely going to be in the headlines and they're going to dominate the conversations. But the three companies that I really need to focus on, that I am focusing on to really set up the way that I am going to trade in November and December, are these three companies. And you might look at the first one and say, what in the heck is this company? Well, this is a company that engages in HR benefits. It's a cloud-based company. They manage company benefits, so healthcare benefits, other types of online payment processing, things along those lines. This company is at a 52-week low. And if companies are anticipating to increase their layoffs, that is where we start to see the concerns move from the inflation side to the recession side. Obviously, we have a lot of economists out there who are saying we're not in a recession, but if we look at TriNet, pay very close attention to their earnings report coming up because their forecast is going to be critical. Our company's going to be cutting back on HR services because they're going to be laying people off. That's going to be very critical because we just heard Bank of America suggest that we're going to wake up one day and we're going to have negative prints on jobs of 150,000 people. And I have said possibly you wake up and it's 200 to 250,000. That appears to be coming. Second is Invesco, and that is a company with a lot of ETFs. And this is really important. These ETFs, we've had a significant amount of passive investing. And what I mean by that, if you think about ETFs, think about the luxury goods ETF that has shares of Apple and shares of Louis Vuitton in it. Think about ARK Invest, which is Kathy Wood's fund that has Roku and a lot of those disruptive companies. As those companies experience outflows, those ETFs have to sell in order to make sure that they are aligning with the amount of capital that they have to invest. On the other side of that, that is a signal of what else is happening at other types of funds. So hedge funds, possibly pensions, go down the line. If people are engaging in redemptions, if they're taking their money out of the funds by definition have to sell according to the structure of their fund. And you have big companies like Apple, for example, 403 companies with exposure to the Apple stock. Imagine a situation where Apple has a terrible earnings report. Imagine a situation where a lot of companies all own, a lot of these ETFs all own the same amount of, a lot of one stock, and they're all heading for the exits at the exact same time. What that creates is, effectively you're trying to push thousands of gallons of water through a pipe this small. And it's a very small window. Michael Burry talked about this last week on Twitter, but this is very evident of things that have occurred in the past. This transpired back in 2020. We've seen it happen in other previous crises. What I'm interested in is Invesco's ETF business because it's kind of gotten out of hand. There's an ETF for anything. They keep creating them. It's a lot of capital that moves into this passive investing. But if money is just coming out of the market, and if we continue to see that transpire or a shift away from these ETFs and into bonds, because we see obviously some of the best opportunities to buy bonds in 20 years, then these ETFs are going to suffer, they're going to struggle, and that can create the next leg down for this market. Not a lot of people have been talking about this. The final thing is PNC Bank. That's the big regional, and that reports tomorrow. So I'm paying very close attention to business conditions on the Atlantic coast. I'm paying very close attention to what is transpiring in this economy, because again, we're moving from the inflationary component to the recessionary component. That is the thesis right now until something breaks.